legalese, let's start talking about pinpointing trends and how to find them, how to understand them, and how to trade them. Now, my personal philosophy is that price is completely random. And the only thing that is always telling you the truth about the markets is price. Because price is a final number. It's not based on this trader's platform, that person's platform, this analysis. Price is price. And nobody can really predict price. It is completely random. It's made up of decisions made by hundreds of thousands, if not millions, of human beings around the globe. Now, there are certain times that price shows non-random behavior. When price exhibits this non-random behavior, we can then start applying some analysis and filters to make some sense of what price is doing at the moment. And these non-random movements in price are better known as trends, because price moves in uptrends and downtrends and sideways trends. Now, most of the time, price moves sideways. Now, it can be edging up or edging down, but it moves in a sideways, congestive manner. It's not making a clear movement up or a clear movement down. It's making a mess. Now, as a trader, you have probably heard the adage that it's best to trade with the trend. The trend, says all the pundits, is your friend. Now, this is sage advice. If you know and can accept that the trend can end, and then the trend may not be your friend. So the question is, how can you determine the direction of the trend? Well, I believe in the KISS rule, which says, keep it simple, stupid. So we're going to take a look, a simple, easy way of evaluating a trend, seeing a trend, and anticipating the end of a trend. Now, in a minute, we're going to go over some live charts and take a look. But before we get started, I want to mention that the importance of time frames in determining the trend. Now, usually when we are analyzing long-term investments, the long-term time frame dominates the shorter-term time frame. But the fact is, most of us are here because we trade CFDs. Most CFDs, now I'm just saying most, are closed within the same trading day. A certain percentage are held overnight, and even a smaller percentage are held open 2 or 3 days. You can keep a CFD open as long as you like. But CFDs, by definition, are short-term trades. And trades can be divided into 3 classes or trading styles: the intraday, the swing, and the position trade. Now, large commercial traders, such as those companies setting up production in foreign countries, might be interested in the fate of a currency over a long period of time, such as months or years. But for speculators, a weekly chart can be accepted as long-term. Now, what do I mean that? My first job at a university was with a big lumber manufacturer called Crown Zellerbach. And my job, now in those days, we didn't have the euro. We had lira, we had franc, we had, my job was anticipating the future value of the currency of each country we were doing business in to buy or sell that country's currency. But I always had to make sure we had enough to pay all the bills over the next few months and where we should be shifting our funds to. Okay, this was what a commercial trader does. This is what we do when you are in business using these currencies. That doesn't really apply to us. In our short-term trading, our goal is to determine the trend direction, not when to enter or exit a trade. Of course, that is not to say that there are no trading opportunities in short-term time frames, such as daily or hourly charts. But for those traders that want to trade with the trend rather than trading the correction, one could wait for a trend to resume and again trade in the direction of the trend. So what is important to us as short-term traders is the trend, not a long-term trend, But as a short-term trader, we're probably going to be using 5, 10, 15-minute charts to make our entry and exit decisions. But we should be looking at the trend in a longer period chart. In fact, we should be looking at a longer term chart, like a several hour chart, maybe even a 1 day chart for the long term trend. This gives you the environmental effect and the environmental outlook of what that asset is doing. Wouldn't you want to know that the euro, which is trading extremely low, but it may look like it's over the last few days in an uptrend, but it's really got the pressure of a long-term downtrend? Well, let's pop up a chart. Let's look at a live chart. Oh, come on, let's go over to my charts. There we go. So let's come over to my teaching chart. This is the euro US dollar. And we're looking at the euro US dollar in a 1 hour chart. Let's go up to today's trading. And we can see that the euro over the past few days moved up a little bit. And we had, at this point, what we could consider an uptrend. And then we move back into a downtrend. And we see a very hard downtrend where it gave back all of its gains and even got lower. Now, if we were to go back, or let's move forward a bit, and let's move this to a 15-minute chart. Come on, charts. I did move it to a 15-minute. Why isn't the price changing? Okay, so now looking at a 30-minute chart, we can see more definitively what that short, what price is doing. And looking at a 15-minute chart, we can see more definitively. But what we want to do is let's go back out to a 4-hour chart. Well, we don't see that surge up as defined as we do, but we do see the down surge. But if we go back a little bit farther on our charts, what can I tell you about the euro US dollar? Well, I can tell you since June, actually since May the 24th, it's been trading in a very, very strong downward trend. We can see in March, it traded in a very strong uptrend. Now it's given back all of those losses. All of those gains, and is far lower now than it was before. So what do we see? We see very strong downtrend, very well-defined uptrend. You see, this is the type of uptrend that we could have successfully traded in. It's well developed, it's well qualified. And we'll talk about the quality of a trend shortly. But now we can see that we are move back into that downtrend. Fact is, this is an extremely low price for the euro US dollar. Okay. Now, if we were to add some other technicals, we might be looking at an ability in a shortly to grab an uptrend, because the euro is not going to go up to 122, but it stays pretty much around this 118 for this quite some time. So 116 is a very, very bottom. So there might be some trading opportunities coming there, but we don't know yet. But trends, hold on, let me get my markers off of here. Trends tell us something. When we have a trend, we can start deciphering what price is doing. Now, when price is moving in those random movements, it's very, very hard, because it's very easy to see push, ease, push, ease, push, ease when I show it to you on a teaching chart. But in essence, in reality, this is what the market trades like. And to find a trading opportunity in this kind of mess is virtually impossible. But these kind of things do actually develop. If you wait for them properly, you will find assets that are making beautiful uptrends and then beautiful downtrends. Okay. And when you can find those opportunities, then you can actually take advantage and find some nice trades. If we were looking here, the S&P 500, look at the waves, look at the nice uptrend pushing up, and you can call them peaks and valleys. I call them pushes. The price pushes up, it eases back down, pushes, eases back down, pushes, eases back down, pushes, eases back down, pushes. Now, here we are using Elliott waves and wave theory, but let's forget about the wave theory. Let's talk about trends. A trend is a series of price movement, making higher highs and higher lows. Okay. And it's one of the ways that we qualify a trend. Okay. When price is making a higher high, a push, and then easing back down and then pushing it, but when it eases back down, it doesn't fall below the previous low. In other words, low, higher low, low, higher low, higher low, higher low, higher low, higher low. And each time it's making also a higher high, higher high, higher high, higher high, higher high, higher high. We have a well-defined trend. When we are doing that, we have non-random behavior. And as I said, when we have this non-random behavior, we can make smart trading decisions. So remember, a trending market is one in which price is generally moving in one direction. Sure, price may go against a trend every now and then, but looking at the longer term time frame would show that those were just retracements. So in other words, when we go back and look in a longer term period, this isn't giving us a trade. It's giving us an understanding of the markets and where we sit in the market. Because what looks like right now as a downtrend or an uptrend can simply be one of those peaks and valleys of a much longer uptrend. So I always break my decision making into three ideas. First, I look at the longer term movement in a longer term time frame to understand the overall movement of the asset. Then I come down to a much shorter term time frame to look at the current price movement, and it's in that shorter term time frame that I'm making my decision not to trade, but making my decision to whether there's a buy or a sell opportunity. Then I go one step farther to a much shorter term frame to see when I would want to enter the market and use that to set my risk and reward and my target prices. Okay. So we would be using an understanding of the trend in three different time frames. But trends are usually noted by higher highs and higher lows. Okay. In an uptrend and in a downtrend, we have lower highs and lower lows. When trading a trend-based strategy, traders usually pick one major currency as well as any other currencies utilizing the dollar because these pairs tended to trend and be more liquid than others. Now, other than eyeballing price action, you can always make use of technical tools that you have learned in other classes to determine whether the currency pair is trending or not. Now remember, there are three types of trends. We have uptrends, which is a series of higher highs and higher lows. We have downtrends, which are a series of lower lows and lower highs, or we have sideways horizontal trends. Okay. We sometimes define these as congestion. Now that's not saying the price is just staying on the side. Sideways horizontal means it's not moving, it's going up and down, and it could be getting higher and then coming back down lower. Okay, but there's no rhyme or reason or understanding. Now, the fact is that price most of the time stays in this sideways horizontal congestion. Now, some chartists consider that a sideways trend is actually not a trend on its own, but a lack of a well-defined trend in either direction. So they could say that if price isn't moving in an uptrend or moving in a downtrend, the lack of either one of those is what that sideways action is. Now, along with these three trend directions, there are three trend classifications that have to do with time duration in which the trend is taking place. A trend of any direction can be classified as either a long-term trend, an intermediate-term trend, or a short-term trend. For Forex trading, a long-term trend is composed of several intermediate-term trends. So here we have the longer-term trend. In other words, here's when we went back and looked at our longer-term chart. In between that, we had short-term downtrends, and we have medium-term uptrends. But for the long, we can see over the long run, this has been an asset that has been pushing and easing, pushing and easing, pushing and easing. The thing is, we also had a problem here because we no longer, at this point, we're sitting here and we're no longer making higher highs. But the thing is, we never made a lower low. So it stayed above without falling down below, and it moved into a new defined uptrend in this medium-term trend. So in other words, we look at it often as long as price didn't make a new lower low, it can still continue in that uptrend. If it broke this trend, in other words, by making a lower low, then at that point, we are no longer looking at a trend, or we're looking at the end of that trend. Now, one of the ways that is, because let's back up, we're not talking about trend lines. Now, a lot of you mix up trends with trend lines. Trend lines are rule-based lines we put on a chart that follow a set of rules. A trend is a view of the movement of the asset. Now, another way to see whether or define a trend, because price is messy. So we say that a moving average takes the noise out of a price. And simply putting a moving average on a chart, especially in our type of trading, a 20-period moving average would at least give us some clarity of the price movement. Using multiple moving averages, we could really define whether price is moving an uptrend. Okay. So if we wanted to place a 720 and a 65 moving average on a chart, then wait until all three SMAs compressed together and began to fan out, we would then know that we had moved into an uptrend. So in other words, here you see when these are put on the chart, they all compress together. But the faster moving average, which is the 7-period, starts moving much faster and fans out. When the three fan out, because what happens is the shorter term moving average is responding a lot faster. The medium term, which is a 20-day, responds a little bit slower, and the longer term, the 65, responds. But when we get this fanning action, okay, we can then know that we've moved into an uptrend. When we get the moving averages coming back together, we can say that that trend is having problems, but as long as the long-term trend holds it, we're still moving in the uptrend. Well, let me get my markers off of here. Now, Bollinger Bands will also help us see a trending market. So one tool that is often used for range-bound strategies can be helpful for trend discovery. We're talking about Bollinger Bands or just bands. One thing you should know about trends is they are actually quite rare. Okay. Contrary to what you think, price really ranges 70 to 80% of the time. In other words, it's the norm for price to range. So if prices deviate from the norm, then they must be in a trend, right? Well, what is one of the best technical tools? Okay. Is standard deviation. And standard deviation is a statistical formula that is applied to Bollinger Bands, and we can then use Bollinger Bands to determine if the market is trending or not. Bollinger Bands make it easy to confirm a trend visually. Downtrend can be confirmed when price is in the sell zone. Uptrends can be confirmed when the price is in a buy zone. Then we have waves. Now, waves are quite complicated, and we have Elliott wave theory. I don't really, it's not that I don't understand waves, I understand them. They're a little bit too complex for me because you have impulse waves and corrective waves, and you have to catch them like I showed you on the chart. Hold on a second. Here we have Elliott waves. Okay, and we can see each wave and each corrective wave. So, but you have to be able to see them and define them because you have A, B's, and C's in impulse waves, and you have 1, 2s, 3s, and 4s in corrective waves. Okay, and you have to be able to find because you just don't arbitrarily say, okay, here's the beginning of a wave, here's the end. You actually have to be able to find them and understand where the A's start from, and then how do you number them from there. So here you can see we have the corrective wave with the A, the B, and the C. And then we go into the impulse wave with the 1, the 2, the 3, the 4, the 5, and then back into a corrective wave. Okay. People swear by them. Traders swear by them. I'm not making a derogatory comment. I just don't use them. Not for any other reason. We all can't use everything. But it's a very, very good way of evaluating the trend and then combining Elliott waves and the wave understanding and the wave numbers with other indicators builds you a very nice system. Like I said, it's just something I don't use, not for any other reason. Okay, so I don't want to turn you off to Elliott waves. I don't want to turn you off to wave theory. It's very valid. But by setting up a short-term exponential moving average and a longer-term simple moving average on a weekly chart or daily chart, it's possible to gauge the direction of a trend. Knowing the trend does help in taking positions, but bear in mind that the markets move in waves. These waves are called impulse waves when it's in the direction of the trend, and a corrective wave when in contrary to the trend. Waves or pivots. By counting the waves or pivots in each wave, one can attempt to anticipate whether a trading opportunity will be against the trend or with the trend. So these are the pushes and the E's, the push and E's, but they're a little bit more defined. There's actually formulas of how big wave push number 2 to number 3 would be in comparison to push number 1. According to Elliott wave theory, an impulse wave consists of 5 swings and a corrective wave usually consisting of 3 swings. A full wave move could consist of 5 swings with 2 of the swings to be counter trend. 1, 2, 3, 4, 5. And the counter trends are the eases. So push, ease, push, ease, push. Because Elliott wave theory can be very subjective, I prefer to use a pivot count to help me determine wave exhaustion. This usually translates into a minimum of 7 pivots when going with the trend, followed by 5 pivots going against the trend. Sometimes the market will not cooperate with these technical assumptions, but it can occur often enough to provide lucrative trading opportunities. By combining a moving average diagnosis with a pivot count and then fine-tuning the analysis with an observation of candlesticks, a trader can stack the odds of making a successful trade in your favor. Remember, trading is a craft. which means that it is both art and science and requires practice to develop consistency and probability. But the bottom line is one of the easiest, most reliable ways to make money trading Forex is to follow trends and let winning trades run as long as they will run. When you trade like this, most of your trades are small losing trades, but sooner or later, they are more than paid for by the large winners. It takes some discipline to trade like this, but it's pretty easy. You don't need to be a genius or even very experienced and knowledgeable to trade profitably in this style. Okay. So following the trends and trading trends can be very easy because when you have the trend, you can jump in and trade and set your stop loss close enough so it moves against you, you get stopped out with lots of little trades. But if you catch the trend right, you can ride that trend up pretty far, and that will offset those small little losing trades you have in between. So what you do need, of course, is at least one trend to exploit. When the Forex market is very flat and trends are completely absent, trend traders cannot avoid losing money if they want to participate. But if you're a trend trader, you sit on the side, you go off and do something else. The identification of patterns and trends are techniques used by analysts studying supply and demand of assets traded in the open market. A trend is the general direction of a price over a period of time. A pattern is a set of data that follows a recognizable form, which analysts then attempt to provide in the current data. Analysts use trend lines and channels, which are essentially boundaries for price fluctuations in an attempt to spot and define trends. So let's show you that on a chart. Hold on a sec. So as you can see here, we've defined a channel. Okay. So this gives us the top and the bottom of the price movement. We can then start making certain assumptions about how price should move. Here again, we've developed our channel. We put it on our chart. Now we've got a confined zone around price, okay, or around that trend. And then we can start making certain trading assumptions. So analysts use trend lines and channels, which are essentially boundaries for price fluctuations in an attempt to spot and define the trends. Upward trends are characterized by an asset price hitting a series of higher highs and higher lows, while downtrends are a series of lower lows and lower highs. There are several analytic tools business can use, and using trend lines can present a clear picture of trend in your business or in your asset you're trading. What is revealed is a possible downturn or uptrend in the direction of a group of values identified in the data. Understanding how to use trend lines can help reveal what might happen in the future. Now, trend lines are a charting technique, which a line is added to represent the trend in a currency pair. Drawing a trend line is as simple as drawing a straight line that follows a general trend. Trend lines can be used to identify trend reversals or the strength of a current trend. So here we're looking at the Euro US dollar chart. Now, we can go on and put a trend line on. Now, when price is moving down, we draw the trend line over top of price. When price is moving up, we draw it underneath. Now, it's pretty easy to drop a trend line on a chart by connecting 2 points. That's all it takes. It doesn't have to be the top of a price, doesn't need a bottom of a price. We can connect 2 points. Until price touches that trend line a third time, it isn't a valid trend line. Okay. Therefore, you can't use it to evaluate your trading. You're waiting for price to touch it again. So trend lines are drawn and redrawn often because whenever price breaks the trend line also, we would have to, it's no longer valid. So for instance, we might say, we might decide to draw a trend line here. Okay. We can draw many and we can constantly remove them from the charts. A trend line isn't a permanent thing, and the trend line only is good while it is valid. So in other words, a trend line is marking the higher lows in a downtrend. And as long as a higher low doesn't break it, a lower high doesn't break it, it remains valid. In an uptrend, we would have drawn it underneath price, supporting price. I say now here, we have one touch, two touch, three touch. Actually, we have five touches right up here. At this point, we have a valid trend line. That means we can then apply a whole bunch of rules in decision making. And this trend line, and the more times it gets touched, the more valid it is. But see what happened is the minute it broke this trend line, that trend line was no longer valid. But price also happened in this case to reverse and move downward. So trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There are a lot of mis and inaccurate information about trend lines, though. Learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into one of the common traps. Trend lines are a technical analysis tool used to define and project price in major markets. Now, as you can see, an upward trend line is drawn at the lows of an upward trend. Notice how price is propped up by this support level. During an uptrend, we see this progress of higher swing highs and swing lows. During a downtrend, we see just the opposite. Pullbacks within a larger trend, such as a pullback on a weekly chart, can often appear as trends on shorter term frames, such as a daily or hourly. Even on a daily chart, there are small waves within the larger labeled waves which haven't been accounted for, which in real time could cause some confusion. Reading price action is subjective, and the basic concepts stay the same, but how each person views them is different. Understanding the basic concepts of price action is crucial because it applies to every trend we trade. If trading with the trend, we want to see this type of movement, higher highs and higher lows. Price charts produce noise. Noise is a small amount of random movement that can make it hard to spot these trends. Therefore, many traders prefer to simplify their charts. And as we talked about, by drawing trend lines, by using moving averages, by using things like Bollinger Bands, we can clarify and define that movement as a uptrend or a downtrend, and a valid, not a valid trend line, but a valid movement when we have that qualified movement. And when we see that qualified movement, we are now looking at non-random behavior that we can then trade. Now, trend lines will often need to be redrawn. Trend lines will often need, they are not a perfect trading tool that tells you exactly where the trend will reverse. You would draw a trend line connecting highs or lows, only see that the next price wave doesn't match up with the trend line exactly. You now must decide if you want to redraw your trend line to accommodate those misalignments. Have you noticed on the chart, we have lots of them. There's nothing wrong just when you discount one or say it's invalid, just get it off your chart and then put the next one, because as the price moves, you're going to put on many, because you would have never, we had this price movement. This was an uptrend. but we could have never predicted that this is the way price was going to move. And we only want to be using the most current trend line because it's the only thing that is valid at the moment. Now remember, there are three important keys to drawing effective trend lines. The higher time frames will produce the most reliable trend lines. Most trend lines you come across will have some overlap from high to low of a candle. But what's important is getting the most touches possible without cutting through the body of the candle. Never try to force a trend line to fit. If it doesn't fit the chart, then it's not valid. It is not worth having on your chart. The goal of every trader is to buy low and sell high within a currency price trend. Trend lines give us a way to identify the high and low ranges of the trend. As an example, if we are looking to buy a currency based on our fundamental view, if it is pulling back to the uptrend line, this gives us an area to buy the currency at a low price in the current trend. The exactly same is true of the opposite in a downtrend. So keep in mind that trends are very fundamental. They give us the rawest decision to make trades. But if you follow my philosophy, that price is completely random. But when price starts to exhibit this non-random behavior known as an uptrend or a downtrend, we can then make intelligent decisions. So what we want to look for is the most qualified trend. You can look at rambling all you want, but what we want is that qualified trend. And believe me, the market are always offering opportunities. Okay. So going out and trying to force something is never a good thing. If I don't have a qualified trend line and a qualified trend and I don't see beautiful price, I don't trade because there's another asset for me to trade. I only want high probability trades. And this is one of the ways to filter down your system before you get into all the decisions of entering trades, what price you'd enter, where you put your stop loss, how to take profit. First, let's see if we have a valid opportunity before we go any farther. So thank you very much for joining us. Have a great trading day. And thank you for supporting Invest Markets. Bye now.